Markets around the world have moved up 12 days out of the last 14, and the right stocks were making the right moves. But is there something more sinister about to occur as we move into OPEX Friday? Today, we talk about what we need to be doing in our portfolio moving into this crazy event with trillions of dollars at stake. We're also going to be talking about oil. It fell 2% overnight, and no one seemed to notice because the talk of the town was PPI and retail sales. With the bears in the driver's seat from the high of the day and $500 billion in SPX Gamma expiring on Friday, was today's intraday sell a telltale sign of more to come? Hello ladies and gentlemen, welcome to the Daily Recap Show where we talk about stocks and the financial markets. If you like this video, please subscribe, hit the notification bell. Let's get into it. It was a very mixed day in the market. There were some winners, some losers. Regional banks right here put in an exceptional day for some reason, but very mixed across the board, across stocks, across sectors. Let's have a look at the SPY. This is the daily chart of the SPY. It was a green day despite being a red candle because we gapped up on the PPI news on the open, and then bulls took us higher just to below the 452 level, and then bears sold all the way down to about 448, and then bulls took us back to equilibrium, closing just below the 450 level. So it was a good push and pull between the bulls and the bears. No real winner. I guess tomorrow and Friday is going to be the decider. In the last 2 weeks of trading, we have left significant gaps in the SPY, and I have some data for you in regards to gaps. So this is the SPY chart after 4 unfulfilled gaps of 0.5% or more in 3 weeks. This has only occurred 9 times. After 4 gaps of 0.5% or more, after 6 months, you generally get a return of 11%, and this has occurred 100% of the time. And this is where it gets really crazy. The average max loss 1.8%. The average max gain was 13.8%. So the risk to reward right there is actually kind of crazy, and we're very close to all-time highs. This is the S&P 500 total return. We are just 1.57 percentage points away from all-time highs if you include dividends reinvested. In my opinion, you should always reinvest your dividends and always stay invested as long as possible. This is the value of $10,000 invested in the S&P 500. Okay, if you had stayed invested all days, you would have made $64,000. If you had missed the 10 best trading days, you'd only be up half of your money. 2008, October 13, 11.6%. A single day for the S&P 500. So guys, this is why you always need to stay 100% invested for as long as possible and reinvest your dividends as quickly as possible, especially for long-term investors. Let's talk about the main driver of the market, treasuries. And it was the entire curve moved up, especially the 10-year, some very big movement in the 10-year. And investors were given plenty of mixed signals from PPI and retail sales. Now, treasury yields rose amid mixed economic signals. The producer price index in October fell 0.5%, slowing from September's revised 0.4% reading. Economists surveyed by the Wall Street Journal forecast a positive 0.1%. Retail sales were also down 0.1% after expanding a revised 0.9% in September, but it was a smaller contraction than the negative 0.2% consensus. And long story short, investors are trying to weigh up, is this good for the economy? What does this mean for yields? And this is why we saw treasury yields mixed, stocks mixed. The bulls won early in the morning, then the bears took over in the afternoon. A very mixed day. But that being said, Fed fund rate futures are exactly where they were yesterday. We're still expecting about a 30% chance of a rate cut in March, 50% in May, and 4 rate cuts all the way to the end of next year. So a couple of days ago, we spoke about the bond trade, and this is what I put on Twitter right here. Expectations for a December rate hike went from 14% to 0% after the CPI print. If this is correct, the Fed will pause for the 5th consecutive month in December, and history tells us that when the Fed pauses for 5 months after a hiking cycle, the hiking cycle is over. So if the Fed pause again next month, the hiking cycle is over, and these are the returns you can expect from bonds. Let's talk about the 20-year and the 30-year treasury. The consensus estimate is that we're going to fall about 150 basis points, and on the 20-year treasury, you can expect a 26% return, and on the 30-year treasury, you can expect 33 3.5% return. And you can see here that if you go down the curve, the returns do get less, but rate cuts falling is generally a very bullish sign for positive bond prices. And that's why the long bond trade is probably the most crowded trade right now, because investors are eyeing this and this as very big returns for 2024, 2025. Tomorrow we get the new sentiment survey, and it's going to be very, very interesting to see where the AA members feel the stock market will be in the next 6 months. We saw a huge bullish shift and a huge bearish shift just from the week prior, and it's going to be really interesting to see where they position themselves, because we're finally seeing the bullish sentiment come into the Russell. The IWM had the largest call volume in over 10 years. Absolutely wild. And people are buying calls en masse, and that means dealers are buying stock as a hedge. We're up 8% in 2 days, I believe. And on the back of this, market breadth in the IWM is improving. 40% of stocks are above their 200 moving day average. And what this means is market breadth is improving, but it's still got a long way to go before it reaches the 60 to 70% mark, which is where you want a healthy market to be. Let's talk about retail sales. US Treasuries rose on Wednesday after fresh data showed retail sales in the world's largest economy held up better than expected in October. The drop of 0.1% was smaller than forecast and was primarily driven by gasoline and motor vehicle sales. Excluding these items, sales ticked up 0.1%. Stronger consumer demand weakens investors' hopes that the Federal Reserve has finished its campaign of interest rate cuts. The benchmark 10-year Treasury rose 0.08 percentage points to 4.52% after the data came out on Wednesday. So long story short, even though PPI data was cooler than expected, retail sales came in hotter than consensus estimates. And what this pretty much means is maybe we're end of the rate hiking cycle, but it doesn't mean a soft landing necessarily. And this is what those retail sales showed. If we do dive into some market commentary I have from BofA right here, despite the decline and pace of growth in September, retail sales were pretty solid. Some payback was expected for the very strong summer the US experienced. Student loan repayments restarted on October 3rd. Non-store retailers were up 0.2%, suggesting seasonal factors probably captured the impact of the additional Prime Day in October. Crazy that Amazon accounts for so much of the retail sales in America. Now, most of the retail sales falling had to do with autos and gasoline prices, and we do know that oil prices are falling on weak global demand. Global demand is very, very weak, and as a result, hedge funds are shorting oil because of the negative sentiment that's around oil right now. Last night, US crude fell 2% as inventories rise because production is at record levels. US crude fell 2%, settled at 76. Brent fell 1.6%, settled at 81.81 for the January contract. And long story short, the world is producing a lot more crude than there is global demand. Even though Saudis are cutting 1 million barrels per day, demand is just not there because the global economy, especially in Europe, is not where it should be. That being said, today was VIXpiration and Friday is OPEX. Max Pain for the SPY is at around 433. We're currently right here, 449. I doubt the market's going to get to, this level right here where Max Pain is. And that is why you should never solely rely on something like Max Pain for trading decisions. There's a ton of factors that come into play, especially with zero DTEs. But let's look at some post-OPEX stats. So this is the Dow Jones Industrial and the Russell 2000, their returns after OPEX. During the week of OPEX, it's generally 11 up weeks, 11 down weeks with a return of 0.1, not super positive. And the week after, it's 12 wins, 9 losses with a return of about 0.62 and not entirely positive as well. The Russell 2000, very similar situation, actually much worse. The week after is normally a down week, 12 times with only up weeks happening 9 times since 2002. And the week after is a little bit more positive, 15 up weeks, 6 down weeks with an average return of 1.16%. OPEX and the week after OPEX, generally negative to flat weeks. And that's because dealers aren't there to support the market and supply with liquidity. Now, the reason why OPEX and post-OPEX weeks are normally weak is because dealers aren't there with their hedging activities to support the market. Normally, option dealers drive huge amounts of liquidity and movement in the market. This is called the window of weakness. These Vanna and Charm flows, they're on holiday. They're not there to support the market. And that's why markets generally drift lower in the last week of the month. But at the end of the month, they come back into the market and they have a strong effect. And they're strong strongest between the second week and right up until OPEX. Part of the reason why after OPEX is weak is because we have $500 billion of gamma expiring on the 17th, which is 37% of total open interest in a single day expiring. And this aligns perfectly with seasonality. This is the Q4 run in the S&P 500. I showed you guys this yesterday. And from about here to here, this is the November OPEX. So you normally have this like weakness in the quarter before you have the major run up. Breaking Q4 down further into November, this is where we are right now, the 15th, and we probably hit the peak right here, and we are expecting some form of sell side to occur for the rest of the month into the end of next week. And on an election year, the sell side can go to about the 24th of the month. Expect weakness to come from about today, tomorrow, all the way to as far as the 24th of November. And here's the game plan I'm following. Right now, I'm currently long on the NASDAQ, and I plan to hold until Jan 15th. I'm starting to build out my 2024 long bond position in TLT. If we do find a low between the 20th to the 27th of November, I'm going to add to my longs QQQ and potentially a position in the Russell 2000 growth. But if no low presents itself, I'm still going to continue to hold my NASDAQ longs. Now, looking at SPX Gamma, we saw some very bullish signs. This was yesterday's chart. The call resistance was at 4450. It has now moved to 4500. Now, a lot of this Gamma calls will be expiring on Friday. But what you can actually see here is that a lot of the put positions have been closed compared to yesterday. As it stands right now, this is very, very bullish, but markets do look a little bit extended. At the end of the day, we are already long. We're holding our longs. We're not trying to chase into anything. Okay guys, moving on to dark pools. There wasn't much in the way of QQQ or SPY dark pools, just a bunch of closes at the end of day, nothing to go by. But the TLT, guys, there's some very, very big stuff right here. I've highlighted this level, very key level, 8850, very, very key level. Look at the trades that have come since. The 8850 level was resistance when it came here, and it's now sort of acting like support. And at this 8850 level, we saw two monster trades. And we also stated last week that the #1 biggest trade since inception came in at 8750. So it looks like there is some form of accumulation happening at this area right here. And look at the trades that came in end of day: 5.2 million, 7 million, and yesterday 5.6 million. And something that's very interesting, look at the trades end of day. Yesterday's trade, this one right here, 5.26 million. Then at the 8850 level, we have another 5.2 million trade. So this trade and this trade was probably the short closed off. Then we had 7 million shares trade right there at this level. So this is probably a long, but for now, this is very, very bullish if you look at it as is. Tomorrow, we do have some more data. We got the CPI on Tuesday. We got PPI retail sales today. And tomorrow, we have initial jobless claims. If we get anything more than 221, that could be bullish, but we are moving into OPEX, and there's going to be a lot of volume coming into the market. So be prepared for high and huge volumes over the next 2 days. But if you've watched up until now, thank you so much. If you like this video, leave a like, please subscribe, share this video with your friends, leave a comment. You know I love you guys.